The stochastic oscillator answers one deceptively simple question: where is price closing relative to its recent range? When closes hug the highs, momentum is alive. When they drift toward the lows, sellers are in control. That single insight, built by George Lane in the late 1950s, still gives you an edge in spotting exhaustion and rotation before price confirms it. Here is the formula. %K equals the current close minus the lowest low over n periods, divided by the highest high minus the lowest low, times 100. The default n is 14. %D is a 3-period simple moving average of %K, acting as the signal line. The slow stochastic adds another smoothing, taming the whipsaws inherent in the raw fast version. Readings above 80 are conventionally overbought, below 20 oversold. But here is the advanced nuance. In strong trends, stochastic can pin at the extremes for extended periods. That is not a reversal signal, that is strength. Use the zones as context, not commands. The real trade triggers come from crossovers and divergences inside that context. The cleanest entry signal is a %K crossing %D in an extreme zone. A bullish cross below 20 suggests buyers are stepping in after exhaustion. A bearish cross above 80 suggests distribution. The further into the extreme zone the cross occurs, the higher the probability. Crosses near 50, the midline, are noise unless confirmed by trend structure. Divergence is where stochastic earns its keep. If price prints a higher high but stochastic prints a lower high, momentum is fading beneath the surface. That bearish divergence often precedes reversals by several bars. Bullish divergence works the same in reverse. Hidden divergence, where price makes a higher low but stochastic makes a lower low, signals trend continuation, not reversal. Watch this synthetic chart. Price rallies, stochastic pins above 80, and the naive trader shorts immediately. Wrong move. The pin confirms strength. Then price grinds higher while stochastic carves a lower high. That divergence is your alert. The bearish crossover below 80 becomes your trigger. Notice the sequence: context, divergence, then confirmation. Here is Apple on the daily time frame. Notice how stochastic stayed pinned during the strong uptrend, frustrating anyone shorting overbought readings. Then watch the divergence build at the swing high, followed by the cross down through 80. That sequence offered a legitimate short-term exit or hedge signal. Real markets reward patience with this tool, not reflexes. For exits, consider scaling out when stochastic crosses back through 50 against your position or when it reaches the opposite extreme. Stops belong beyond the structural swing that produced the divergence, not at arbitrary indicator levels. Remember, stochastic tells you about momentum, but price tells you about risk. Anchor stops to price structure always. Stochastic excels in ranging markets, where price oscillates between definable highs and lows. It is responsive, intuitive, and bounded between 0 and 100, making cross-asset comparisons straightforward. Divergence signals often lead price, giving you preparation time. And because it normalizes by range, it adapts naturally across volatility regimes without parameter tweaking. In strong trends, stochastic generates relentless false reversal signals. The fast version whipsaws aggressively, which is why most professionals run the slow or full variant. It also struggles around news-driven gaps, where range calculations distort. And like all bounded oscillators, it cannot distinguish between a healthy pullback and a genuine breakdown without external context. Pair stochastic with a trend filter to eliminate counter-trend traps. A 200-period moving average works well. Only take long stochastic signals above it, only shorts below it. ADX above 25 warns you the market is trending, so demote stochastic to a pullback timing tool. Combine with horizontal support and resistance for the highest probability setups. 3 traps to avoid. 1. Shorting purely because stochastic is overbought in an uptrend. That is a recipe for chronic losses. 2. Ignoring timeframe alignment. Stochastic on the 5-minute against a daily trend is noise. 3. Over-optimizing parameters. The classic 14-3-3 works because it is robust, not because it is magic. Resist the urge to curve fit. To recap, stochastic measures close relative to range, signals via crossovers in extreme zones, and earns its keep through divergence. Use it in ranges, filter it in trends, and anchor stops to price structure. Tomorrow, pull up your watch list, identify the regime first, then look for divergences at key levels. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.